Hey everyone, and welcome back for another deep dive.
Always fun to dig into these topics.
So this time we're looking at equipment financing for small businesses.
Hmm,
Um,
that
and
was a good one.
yeah, we've got a few different sources kind of from both sides of the aisle as usual. Um, and our mission here is to help you guys navigate this sometimes really confusing world.
Yeah, it can definitely be a bit of a maze out there.
Absolutely. So whether you're a seasoned entrepreneur or just starting out, this deep dive is for you. And let's face it, equipment is like the backbone of so many businesses.
It really is. I mean, try running a restaurant without a decent oven or a construction company without a backhoe.
Right, exactly. You're not getting very far.
Yeah.
But buying all that equipment outright,
Right.
that can be a huge financial strain, especially when you're first starting out.
Yeah, and that's where equipment financing comes in. It's not just about affordability, it's a strategic tool for growth.
I love that. And one of the sources we're looking at today actually uses this analogy. Imagine a carpenter trying to build a house with a plastic hammer.
Okay, I can see where they're going with that.
Right. You wouldn't stand a chance in today's market with outdated equipment. So how do you get the equipment you need without, breaking the bank?
That's where financing comes in. And the great thing is there are tons of different options out there. It's not a one-size-fits-all situation.
Okay, so let's break down that financing landscape.
Yeah.
What are the main categories we're talking about here?
Well, you've got your loans, of course, your leases,
Um,
and then some interesting government-backed programs, too.
Okay. And even within those categories, I'm guessing there's a lot of variety.
Oh, tons. And that's actually good news because it means you can find something that's really tailored to your specific needs.
So it's not just picking between door number one or door number two. There are a lot more doors.
A whole hallway of doors, actually.
Perfect. Now, I was looking through the sources earlier, and there were a few things that really jumped out at me. First, have you ever heard of equipment financing agreements?
EFAs. Yeah, they're kind of a hybrid between a loan and a lease.
Oh, that's interesting. So kind of the best of both worlds.
Potentially, yeah. But we'll definitely dive into those a bit more later and see how they actually work.
Okay, cool. And then there are those SBA loan programs, which I feel like we hear a lot about these days. Lower interest rates, longer terms.
Yeah.
Sounds pretty appealing, right?
Sounds great on the surface, but there can be some catches too. We'll unpack those as well.
Perfect. So let's start with loans because I feel like that's what most people think of first. Can you give us a little loan 101?
Sure, so with loans, you're basically borrowing a set amount of money and then repaying it over time with interest.
Okay, pretty straightforward.
Yeah.
But even within loans, there are different types, right?
Oh, yeah. You've got term loans, which are kind of the standard loan you pay back over a fixed period of time. Then you've got secured loans and unsecured loans.
Okay, so what's the difference between those secured versus unsecured?
So with a secured loan, the equipment itself acts as collateral. Basically, if you can't make the payments, the lender could seize the equipment.
So basically, with a secured loan, the equipment itself is on the line.
Exactly. Unsecured loans, on the other hand, they don't require that specific collateral, but they usually come with higher interest rates because they're riskier for the lender.
Makes sense. So is it always better to go with a secured loan then?
Not necessarily. It really depends on your financial situation and your risk tolerance. If you have good credit and are confident you can make the payments, an unsecured loan might be a good option. But if you're worried about the possibility of defaulting, a secured loan can offer some peace of mind.
Got it. So it's all about weighing those pros and cons.
Absolutely. And don't forget, your credit score plays a huge role in all of this.
Oh, yeah, that credit score is like your financial report card.
Exactly. Even with unsecured loans, a good credit score can get you a much lower interest rate. So if you're thinking about financing equipment, that credit score is something you'll want to keep an eye on.
Absolutely. Good credit can save you a lot of money in the long run. Okay, let's shift gears and talk about leasing now. This seems like a good option if you're in a fast-paced industry where technology changes quickly.
It can be. With leasing, you're basically renting the equipment for a set period of time.
Okay, so instead of owning it, you're just paying to use it.
Exactly. And that can be a good option for businesses that need to upgrade their equipment frequently or maybe don't want to deal with the hassle of maintenance and repairs.
Makes sense. So are there different types of leases?
There are. You've got operating leases, which are basically like renting. You make monthly payments, and then at the end of the lease term, you return the equipment.
Okay, pretty straightforward. But I've also heard of capital leases. What are those?
Capital leases are a bit more complex. They're actually more like financing a purchase.
Hmm.
You make payments over time, just like with a loan, and then at the end of the lease term, you usually have the option to buy the equipment for a predetermined price.
So it's kind of like a rent-to-own situation.
Sort of, yeah.
Yeah.
But with capital leases, the lease payments are typically higher because they're designed to cover the full cost of the equipment over the lease term.
Got it. So you're essentially financing the purchase, but with the added flexibility of being able to return the equipment at the end if you don't want to buy it.
Exactly. And then there are these lease-to-own agreements, which are kind of a hybrid between an operating lease and a capital lease.
Oh, so you're basically renting but building towards ownership.
That's the idea. It can be a good option for businesses that want to eventually own the equipment, but maybe can't afford a large down payment or qualify for a traditional loan.
Okay, but are there any downsides to these lease-to-own agreements?
There can be. Sometimes the overall cost can end up being higher than if you had just taken out a loan.
Hmm.
And you don't actually own the equipment until you've made all the payments. So if you miss payments along the way, you could lose out on both the equipment and the money you've already paid.
Oh, that's a good point to keep in mind. So it's really important to weigh those factors carefully.
Definitely. There's no one right answer when it comes to leasing. It all depends on your specific needs and your financial situation.
Okay, so we've covered loans and leases. Now let's circle back to those SBA loans we mentioned earlier. There seems to be a lot of buzz around them these days. What's the real story there?
Well, the SBA actually offers a couple of key programs for small businesses: the 7A program and the 504 program. Both of them aim to make financing more accessible for small businesses.
And I've heard that they can offer lower interest rates and better terms than conventional loans. Is that true?
They can, yeah. The SBA partially guarantees these loans, which makes lenders more comfortable working with businesses that might not have a long credit history or rock-solid financials.
So that SBA guarantee is kind of like a safety net for the lender?
Exactly. And that can translate into better terms for the borrower.
Okay, but there must be some trade-offs, right?
There are SBA loans often come with more paperwork and a longer approval process, so if you need financing quickly, this might not be the best route.
Got it. So it's not a magic bullet, but it's definitely an option worth considering.
Absolutely, especially if you're a small business that might not qualify for a traditional loan.
Okay, so now I'm curious about the lenders themselves. Is it just banks we're talking about here, or are there other options out there?
Oh, there are tons of lenders out there. You've got your traditional banks, of course,
Yeah.
but you've also got credit unions, online lenders. Even the equipment manufacturers themselves sometimes get into the financing game.
Wait, seriously? Manufacturers offering financing? That's interesting. Tell me more about that.
It's becoming increasingly common, especially for specialized equipment. Think about it. A manufacturer has a huge interest in getting their equipment into the hands of businesses who will use it successfully. So they're often willing to offer competitive financing terms, especially to newer businesses that might not qualify for a traditional loan.
That's a really good point. I wouldn't have even thought to check with the manufacturer for financing options.
It's definitely worth exploring, and it highlights the importance of shopping around and comparing offers from different types of lenders.
So it's not just about finding the right financing option, it's also about finding the right lender.
Exactly. The right lender can make all the difference. They can work with you to find a solution that fits your specific needs and help you navigate the whole process.
Okay, so let's say you've done your research, you know what type of financing you want, and you've got a few potential lenders in mind. What's next? What do you need to have ready to go before you start applying?
Well, first and foremost, you need a solid business plan. This is your chance to really sell your business to the lender and show them why you're a good investment.
So basically, you're trying to convince them that you're going to be successful and be able to repay the loan.
Exactly. Your business plan should clearly lay out your business goals, your target market, your revenue projections. It's basically your roadmap to success, and you're using it to persuade the lender to come along for the ride.
Okay, that makes sense. And I'm guessing financial projections are super important too, right?
Absolutely. Lenders want to see that you've thought through the numbers. They want to know how this equipment is going to help your business grow and generate enough revenue to cover the financing payments.
So you're essentially trying to prove that this equipment is a strategic investment, not just a shiny new toy.
Exactly. Lenders want to see a clear path to success, not just a piece of equipment sitting idle.
Okay, so a solid business plan, financial projections. What else should you have ready?
Well, you'll definitely need your financial statements, your balance sheet, your income statement. Lenders want to see the hard numbers.
So they can get a clear picture of your financial health.
Exactly. And then you'll also need information about the equipment itself. Detailed specs, quotes from vendors. Lenders will want to know exactly what you're financing, how much it costs, and whether you've shopped around for the best price.
So you're basically building a case for why this specific equipment is the right choice for your business and why it's a worthwhile investment for them.
Exactly. And don't forget that your credit score plays a big role here, too. It will impact whether you get approved and the interest rate you'll qualify for. The better your credit, the better your chances of securing favorable terms.
Okay, good credit is key no matter what. It's like the foundation of the whole financing process. But even with good credit and a great business plan, there's still that approval process itself, which can feel like a bit of a black box. What actually happens behind the scenes once you submit your application?
Well, it varies from lender to lender,
Right, of course.
but there are some common steps. First, they'll review your application, make sure it's complete and you've included all the necessary documents.
So this is where being organized and prepared really pays off. If your application is a mess, it's probably going straight to the bottom of the pile.
Yeah, you don't want to make a bad first impression. Then comes the credit check.
The dreaded credit check.
It's not as scary as it sounds. They're basically just looking at your credit history to see how you've managed debt in the past.
And this is where that good credit score we talked about really shines.
Absolutely. A good credit score tells the lender that you're a responsible borrower and you're likely to repay the loan. Next, they'll take a close look at your financials.
So that's your balance sheet, income statement, all that stuff.
Exactly. They're looking at your revenue, your expenses, your cash flow. Basically, can you comfortably make those loan payments each month?
So even if you have a stellar credit score, if your financials are a mess, you could still get turned down.
Absolutely. Lenders want to see the whole picture. They'll also evaluate the equipment itself.
Oh, right, to make sure it's actually worth what you say it is.
Exactly. They'll look at its value, its expected lifespan, and how it fits into your business operations.
Makes sense. They don't want to lend money on something that's going to break down or become obsolete right away.
They're trying to manage risk just like you are. And they'll also consider broader factors like your industry, your business model, and the overall economy.
So even if everything else looks great, if you're in a volatile industry, you might face stricter terms or even a rejection.
That's true. Certain industries are just seen as riskier than others, so it's important to be aware of that. Then, after all that, there's the underwriting process. This is where a specialist really digs into all the details to figure out your creditworthiness and the viability of the loan.
So this is where they scrutinize everything with a fine-tooth comb.
You got it. They're looking for red flags and consistencies. Anything that might suggest you won't be able to repay the loan.
Okay, so it's a pretty thorough process.
It is. They want to make sure they're making a good investment.
And based on all of that, they'll recommend whether to approve or deny your application,
Right. And if you're approved, they'll give you a loan offer.
which outlines all the terms and conditions.
Exactly. The loan amount, the interest rate, the repayment terms, all the nitty-gritty details.
And this is where you have to read the fine print, right?
Absolutely.
Yeah.
Don't just sign on the dotted line without understanding everything. And here's an important point. You can actually negotiate these terms.
Really? I didn't know that.
Yeah, a lot of people don't realize that. But you don't have to just accept the first offer they give you. If something doesn't seem right or you think you can get a better deal elsewhere, don't be afraid to push back.
So it's not a take it or leave it situation.
Not at all. There's often some wiggle room, especially if you have a good credit history and a solid business plan.
Okay, good to know. So once you've agreed on the terms, what happens next?
There's usually a final verification process where the lender double checks everything and might ask for updated documents.
It's like they're making sure nothing major has changed since you first applied.
Exactly. And once that's done, you'll sign all the paperwork, close the loan, the funds will be released, and you can finally get that equipment you need.
Okay, so you've navigated the application, secured the financing, but the journey's not over, right? Managing that financing effectively is crucial.
Absolutely. You've got to have a plan for how you're going to make those payments.
So this is where budgeting and cash flow management becomes super important. You can't just wing it and hope for the best.
You've got to be proactive. Know how much money is coming in, how much is going out, and where those loan payments fit into the bigger picture.
Right. If cash flow is tight, you might need to adjust your spending or look for ways to increase revenue.
Exactly. And don't forget those unexpected expenses, repairs, upgrades, those unexpected costs that can really throw a wrench in your budget.
It's a great point. It's essential to have some sort of contingency plan. Maybe it's a rainy day fund or a line of credit specifically for those equipment emergencies. You've got to be prepared.
Those unexpected costs will happen. It's just a matter of when.
Speaking of unexpected costs, what about regular maintenance? It's often overlooked, but so important to keep your equipment running smoothly.
You're absolutely right. Regular maintenance can prevent expensive breakdowns later on. So factor those costs into your budget. Stick to the recommended maintenance schedule and nip those minor issues in the bud before they become major problems.
And don't forget about insurance.
Oh, yeah, that's crucial. Make sure you have the right coverage in case of damage, theft, even a breakdown.
Insurance